Welcome to Boom Trader's educational video. My name is TinTinTrading. In today's tutorial, we will guide you through the process of calculating the implied volatility or the anticipated movement of a stock's price following its earnings announcement. We'll use the recent earnings event of Salesforce as our example. Salesforce announces its earnings on 28th February after the market closed, with the stock trading today around $298 to $300. You can find the necessary data for options, which is crucial for our analysis, on the Chicago Board of Options Exchange website, CBOE.com. While this site offers quotes for free, albeit with a slight delay, most trading platforms provide real-time options pricing through your brokerage account. For illustrative purposes, we will examine the call and put option prices closest to Salesforce closing price of $298. When choosing options, we aim for those with the nearest strike price to $298, which serves as a rough estimate. For a stock like Salesforce, which offers weekly options, this task is straightforward. However, for stocks with only monthly options, the calculation becomes slightly more complex due to the additional time value in the options pricing. Focusing on the immediate aftermath of Salesforce's earnings, we consider options expiring on March 1st, 2024. To perform our calculation, we take the price of the put option at 11.6 and the call option at 10.7, totaling $22. To refine our estimate, we account for the stock price's slight deviation from the strike price, a difference of approximately $2 for the call and $0.50 for the put, adding another $2.50 to our total, bringing it to $24.80. Dividing this amount by the stock's closing price of $298 gives us an expected movement range of approximately 7% to 8.3%. This calculation indicates that the stock could either increase or decrease by about 7% to 8% following the earnings report. Highlighted in our chart, this expected range includes potential upward and downward movements, aligning with our preset stop levels. In this scenario, the anticipated price fluctuation based on options market data falls within our acceptable risk parameters, offering reassurance for holding the stock through the earnings event. It's important to note that these figures are based on market sentiment and real money bets on the stock's movement post-earnings. While not a guarantee of accuracy, they offer a valuable perspective on market expectations. This guide aims to help you understand and apply the concept of implied volatility to anticipate stock movements through earnings events, utilizing options market data. Thank you for joining me in this tutorial.